Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. All right, housing bubble, housing market, whatever you want to call it, that's me. And today is October the 10th. We're basically a third through the month. Lots on the go in real estate once again. Clearly all the sales activities and values, those are always reported towards the end of the month. So we have to fill in with specific news items that are somewhat interesting or unique throughout the first part of the month. So here we go. All right. Basically, I saw an article today, more like a video from CNBC, and it talks about house prices are correcting. So there's the CEO, her name is Diane Ramirez. She's from Halstead. And this is a New York City-based real estate firm. Really what it boils down to, and we're hearing a lot of this coming from the New York City area just because they're experiencing a lot of change with respect to what's going on in their market right now. She basically is saying that luxury market has a lot more inventory these days. Prices are correcting, so she basically is using the term correcting. So we've seen shifting, rebounding, whatever you want to, however you want to classify or whatever word you want to use to talk about the real estate market. She's using the word correct, so she's saying it's correcting. And it's now a buyer's market in New York City, and this is starting to happen across the nation. Now, she's referring to more of the luxury home markets across the nation, and we know if you take a look at tracking that there's a lot of changes happening right now, and that market is being significantly hit. Rates are helping buyers, obviously, in this demographic, and I guess you could say, activity is up when mortgage rates go down, which we typically understand. And she says, particularly when rates are below 4%, that's what part of the article or the video discusses. There's another guy on there who's a mortgage dude. When rates are down below 4% is when we see activity really pick up. So above 4%, there's a noted slowdown. Below 4%, there's certainly a lot of activity. The comment here, though, is the housing market is more diversified than nationalized. And what they mean by that is you can't just say, the market is X or Y across the country on a national scope. And the reason being because we have many different metros. And we really have now, and I agree with this as well too, we have sort of like your three distinct tiers of housing. You have your affordable housing, have your mid-range, and you have your luxury. So, you could have a market that's having a terrible time with luxury home sales, yet we have low inventory, or, those prices are still gaining in the mid-tier level or the lower level. So there really is, they call it more like a diversified market in that respect. So it's almost like, we're looking at market specific, metro specific, and then market specific within each metro. And that's kind of the issue. So to say we're in a housing bubble or housing crisis or housing's great, I guess either way is an incorrect statement. You have to take a look at your locations and your segments within your location. So let's keep that in mind. But again, just as a generalized statement, certainly the high-end homes are having a lot more difficulty, and certainly in different parts of the country, they're actually for example, New York City, just lots of foreclosures are spiking up in that area as far as the high end. Also with the SALT, state and local taxes, lack of mortgage deductions, whatever, we're seeing how that's affecting. And New York also has the luxury house tax as well too. So that's really affecting sales and price points and movement in that area. All right. Something came out in the Wall Street Journal the other day, and it's really talking about, buying a home no matter where the market. I subscribe to the Wall Street Journal, so it's, usually every so often there's a good op-ed about what's going on. In this case, they're talking about three markets: a seller's market, buyer's market, and second home market. And they did some analysis here. So for the purpose of this discussion and this article, we'll talk a little bit about what the seller market means here. So seller's market means the market has more demand than supply, with low levels of inventory and a high absorption rate. Sales prices in the top 5% of the market are growing at or above 4% year over year. So when you take a look at the top sellers market across the country, this is what the information pulls. And this actually was, a lot of it was, source was Realtor.com. So it's not an offshoot real estate company doing this. It's Realtor.com supplying the information. So obviously you can take a look at the top sellers market tend to be, look, California, Contra Costa, Sacramento, you got Virginia, Pinellas, Florida. Now Pinellas is actually a county, so I'd see they're grouping this in counties as well too. Broward in Florida, number 10 is a county. Riverside, Boulder, Placer, California. So obviously there's still some higher price points in these locations, and sellers are still, I guess you could say, calling the shots with respect to activity and things like that. So just keep that in mind. Now absorption rate is a percentage of the homes that are sold, etc. All right, if I take a look at this a little deeper and we take a look at what is a buyer's market, well, in this analysis, the market has more supply than demand with high levels of inventory and relatively low levels of sales. Luxury sales prices, the top 5% of the market were growing less than 1% or declining year over year, which is quite interesting. So if we take a look at the top buyers markets, we've got Suffolk, New York, Monroe, Florida, which that's a county, Cook County, Illinois, we've got Honolulu, Hawaii, Collier, Florida, that's Collier County, that's where Naples is. Sarasota, that could be either Sarasota City itself or Sarasota County. Montgomery, Pennsylvania. Duval, Florida, that's the county, that's Jacksonville area. And Philadelphia, Pennsylvania. So obviously, a buyer's market is slow absorption rate, which means there's more homes out there and you've got more chance to call in your prices, which is interesting. So if you're looking for homes, maybe you'd want to hit those locations. You could say, if you go even deeper, they actually have what's a hot second home market. Cities where 10% or more of the purchases are really for second homes. Top 5% price band is higher than the national top 5% price band. So if we take a look at the actual hottest second home markets, looks like you've got Palm Springs, California. You got Nokomis, Florida. That's just actually south of Sarasota on the Gulf side. Looks like Wisconsin, La Jolla, Key West. Obviously there's Key West is expensive. Key West has had some issues in the past due to some of the hurricanes that came through there and some of the damage. So my comment could be there could be less homes for sale there. Coeur d'Alene, Idaho, and that's just actually across from Spokane. So I know that market a little bit. I know people up there who speak to me about that, and they say it's actually a growing market. People are buying their homes there. Now, whether they're buying their home there to have a home to eventually relocate from other parts of the West Coast, we don't know. Jupiter, Florida, that's golf paradise on the east coast of Florida, essentially. You got Beach Haven, New Jersey, and I don't know how to say this, but it looks like Kahai, Hawaii. So there you go. So that's your hottest second home markets. Again, I look at certain locations and say, St. Petersburg. I mean, that's obviously next door to where I'm at. And the second home markets may not necessarily be the city or the proper, but it could be along the coast. I mean, a lot of these are coastal locations. Funny enough, most of them are, and that's how it plays out. But again, St. Petersburg, there's a lot of stuff on the Gulf Coast. It's a lot of opportunity in that area. So there you go with respect to that. Let's move on to Black Knight Financial. The U.S. housing affordability spikes in September. Now, it's funny. This is almost like a reverse index here, because when housing affordability spikes, it means it means that it means it's more affordable. So it's funny, like the index goes up, which you would think, well, that means unaffordable. But no, if that spikes, it means things are more affordable, and there's opportunities for buyers there. So it says during the month, housing affordability climbs to a near 3-year high. And kind of like what I've said all along over the past year, that we go through seasonality, and there's the summer selling season that we've just been through. So in different parts of the country, that summer selling season may end a little earlier, like maybe in August. Typically, end of September or Labor Day is kind of when everything across the country, everyone's back in school and people have moved around or whatever. So obviously, what's going to happen is homes that haven't sold will drop prices during that month. And people will also look at price points. If they list them, they'll probably list them a little less price as well too. So therefore, that makes sense. The U.S. housing affordability spikes in December, so it's more affordable, in September than it was previously, which is in line with what we expected after the summer selling season. So there's no surprises there. Just validates what we talk about. Okay, the housing market's rebound is no mirage. All right, this comes from Bloomberg. It's an op-ed here. So again, op-ed opinion, right? Editorial. So it's someone's thought on this. It's not necessarily the be all and end all of news, but basically, and this funny. I have a future video which I'll do that will talk about these things as well to invalidate what we talk about here. Very interesting. But housing is the most rate sensitive or interest rate sensitive sector of the economy, meaning it stands to benefit more than any other from the Fed having cut its target interest rate by 0.5 percentage point since July. So yes, and from many sources, it's interest rate sensitive to a point. Obviously, the concept when it drops, if mortgage rates drop along with it, then the concept of your buying power, things are more affordable. I guess you could say come into play. Technically, they're not more affordable because the price points of a home doesn't change. Just your buying power changes. So you're not getting a deal. You're just actually saving money or able to in theory purchase higher because your rate has allowed you that extra space with your monthly payment, etc. So as I always say, we're not buying a property on price, we're buying a property on payments. That's how this world is kind of operating. So again, as I've mentioned, and what we'll hear in some of the media is that when rates drop, everybody jumps on the bandwagon and says, hey, housing's going to rebound, or it's rebounding. We see all these great things. Well, and also when you hear things like wages, not wages, but unemployment being down to like what it was 3.5%, whatever it was recently. So, but this is interesting because some economists note that September jobs report suggests housing is buffeted by conflicting data, which is cool. And the chief economist from Gluskin Sheff and Associates, who called the last housing cycle ahead of his peers, good for him, cited stagnation in job growth in residential construction, home furnishings, and building material outlets. And as for the alleged rebound in the housing market, he said, someone forgot to mention that to the realtors because we had 3,000 fewer agents on the job in September. So I do find that, first of all, I find that refreshing that someone is calling this out, saying, don't listen to what you hear in the mainstream media because things are actually changing and we have to be aware of that. Funny enough that construction down, obviously, and the throw off of buying homes and building homes is residential furnishings, building materials, all the things that happen when we purchase a new home, whether it's new or used, the stuff that you do and you buy extra items and do more services, whatever. So that's jumping down or becoming less and less. But I like the fact that we had 3,000 fewer agents on the job in September. So when we have high growth or high appreciation in property, it's been I guess statistically speaking, you can verify and prove that the real estate agent, I guess you could say employment or the number of agents grows along with that because everybody feels that if it's a good market, that money's to be made, and I'm going to become a real estate agent because, hey, I might get a couple transactions, I can make some quick money, etc. Well, funny, when that's sort of over, we see a contraction in real estate agents as well too. So a lot of them don't renew, and I can tell you, September is the month where, at least where we are in Florida, it typically is, there's 2 times of the year where you renew your license. So you renew your license with the state, and that usually is based on a couple year expiration, and sometimes you have to take your continuing education. So it's funny around these times. So usually it's typically end of March and end of September, where if you don't renew and you don't want to be in the market anymore, you're just not going to do that. So therefore the numbers are going to fall off. So I think it's not a huge number, but at least it's an indication that, hey, maybe people are going, okay, I think the peak is over and there's not going to be as many opportunities. There's low inventory, more competition. I got to hustle more to get a deal. I have to spend more on marketing to get a deal. It's not making sense for me from a cost benefit perspective here. I'm not going to continue with my real estate career, so to speak, whether that's full-time or part-time. So keep that in mind. Also, he said fresh data from Black Knight Financial also questioned the housing turnaround story. In each of the past 5 months, 90-day mortgage delinquencies have either been flat or slightly up year over year. The Midwest floods easily explain August defaults rising 10% from the prior year in that region, but the month also saw defaults increase 8% in the south and 4.5% in the northeast, leading Black Knight to warn that though default activity remains historically low, this is a trend worth watching. So again, not many people talk about this, and we don't really focus on it. To me, it's a leading indicator of other economic problems that will affect the housing market in the next little while, very shortly. So you keep that in mind here. So I just think that's very interesting, and I do appreciate when somebody calls it like it is and actually lays out what's really going on in the marketplace. So let's jump on, and again, this is from Housing Wire. Is the housing market heading toward an inventory downturn? Well, it's supply and demand. So we're still going to see areas that will have some appreciation, even though we've seen from the Realtor reports from Realtor.com or our National Association of Realtor, and we've seen the Case-Shiller, we've seen that the appreciation is decelerating. The difference is going to be in some markets, if there's still a lack of inventory, there still could be some competition, or there still will be price gains, albeit the gains are smaller and smaller every month. So just keep that in mind, that people are still, like CoreLogic, Fannie and Freddie, whatever, a lot of people are saying we're going to see price increases next year solely on the fact that we have less inventory. So it's not like, again, it's not wages, it's not price point, it's just basically inventory, and that's going to create still some more competition. So please be aware of that. Now, how do you, combat that? Well, of course, what I like to talk about, these things here, okay, short sales. This is a market that is not looked at by real estate agents, not looked at by home buyers, not looked at by real estate investors. I call it the 1% rule because typically 1% or less of all transactions across the country, even the metros, are short sales, which means, but we know that from the data and from what the reports are, that foreclosures and mortgage defaults and those filings are increasing. They're maintaining and increasing as the year goes on, and over the past couple of years as well too. So that's an inventory area that's not tapped into, which is what I participate in. And this is a side note, as I always mention this to everybody, but now we're talking about this in the middle of the conversation, is that if you're looking for information on that, please reach out to me and contact me, because this is where the opportunities lie, and for a lot of people out there in real estate. So please reach out and we'll go from there. All right. Uptick reported in mortgage activity. Now, the Mortgage Bankers Association, MBA, reported a 5.2% application increase from the previous week ending October 4th. Also, the refinance index rose 10% from the week prior and is 163% higher than it was year over year. Seasonally adjusted purchase index fell 11% week over week, but was 10% higher from the same time last year. So MBA also reported that the refinance share of mortgage activity increased to 60.4% of total applications, up from 58% the week prior. So we basically have, high 50s, low 60s percent of all the applications coming are for refinancing. So as we've talked about, as I mentioned, if you're not selling your home, or you don't want to, or maybe you missed the mark, or perhaps you don't feel that the market is sustainable, that you can get your equity out of the home through a sale, what are you going to do? You're going to refi. So when we have 60% of people refining at the top of the market, essentially, and what they don't really get into here, but we know that a lot of the refis are not just rate and term. A lot of these refis, in fact, the majority, are cash out refis. So people are going to equity strip and equity bleed their homes, which will leave them in situations in the near future if property values continue to decline. So that's something to think about. Back in the last housing crisis, I've mentioned this before as well, a lot of people blamed the subprime mortgage meltdown as the reason for the housing crisis. I will tell you that subprime mortgage meltdown was kind of the catalyst that started everything, and everything kind of broke from there. But the number one issue of the mortgage, of the last housing crisis, was too many people were equity stripping with second mortgages and home equity lines of credit. That accounted for a lot of money and put a lot of people underwater, and they couldn't pay it back. Simple as that. All right, so next, funny enough here, this is on the lines of mortgages. It's actually about where are mortgages denied the most. So when you apply for a mortgage, you just don't just get one, right? You have to go through the application process and provide your tax returns and your wage statements and your investments, money in, money out, household expenses. So a new report that came out from LendingTree revealed that the state of Florida has 4 of the top cities with the highest mortgage denial rate. So Miami came in number 1 with a denial rate of 11.6%, with the leading cause of rejection being home buyers' debt-to-income ratio, which was cited in 32.4% of failed loan applications. So maybe these people should be looking at FHA mortgages, because we know that FHA has the QM patch removed, and they allow higher debt-to-income ratio applications or mortgages. Orlando was a close second with a denial rate of 10.9. Tampa with 9.5. So there you go. And again, we're over 30% is the debt-to-income ratio. Additional markets that were in the top 10 include Detroit, Birmingham, Alabama, Houston, Texas, San Jose, New York, and San Antonio, Texas. Now, the flip side is the locations with the least amount of denials was Minneapolis, Minnesota, where they were denied a 4.6% rate. Borrowers in Salt Lake City were next. Kansas City, Missouri next. Other markets with low denial rates were Virginia Beach, Virginia, Portland, Oregon, Washington, D.C., St. Louis, Missouri, Boston, Massachusetts, Richmond, Virginia, and Raleigh, North Carolina. So there you go. Now, overall, LendingTree stated that nearly 1 in 10 borrowers get denied for mortgages, and the national denial rate is 9.8%. So there you go. So you can see that some of these locations are over the 10%, some are below. So just under 10% is our national denial rate. Typically, it's debt-to-income ratio is what's been happening, and that's the cost for all this. But it's funny to note that because we don't really hear about this. We typically hear about debt-to-income ratios and lower rates and people jumping on, but we never really hear about people being denied for this. So whether they had the wrong mortgage program they applied for, went to their bank or credit union, went to an online setup like a Rocket Mortgage or Quicken Loans or PennyMac or like the non-prime borrowers, the non-banks, we don't know, but this is just kind of based on LendingTree's information here. So very, very kind of interesting. All right, I think this is funny because I've been involved in some of this, working in what I've done in real estate the past number of years. So the FTC, which is the Federal Trade Commission, claims house flipping seminars featuring HGTV stars are total scams. Funny that they talk about that now, right after the height of the market and all these other things that have gone on, all these flipping things that have happened over the years. So did you ever think that those celebrity endorsed get-rich-quick by using other people's money to flip houses real estate seminars seem too good to be true? Well, it turns out that you may have been right. So the Federal Trade Commission and the Utah Division of Consumer Protection, we'll talk about Utah in a second here, announced this week that they are charging a Utah-based company with allegedly lying to consumers to convince them to attend the company's supposedly free real estate seminars. The company promised to give away the secrets to making money flipping houses at the event, but actually charged thousands or tens of thousands of dollars to obtain said secrets. My goodness. So the company is called Zurich, Zurixx, and typically they're using HGTV stars, so we know we can flip on the TV and you see people like Tarak and Christina Al-Musa, whatever their name is, Musa, whatever they're called. Hillary Farr from HG Lover Listed, Pete Harris and Dave Seymour from A&E Flipping Boston. And I've actually, I know I've met Dave a number of times at certain events and stuff. Nice guy and everything. But here's the thing: is that they're going out making the TV shows and they're lending their credentials to these companies. So according to the FTC, the ads convince consumers to attend free events that would teach consumers how to make large profits by flipping using other people's money. The agency claims that the free events are actually a sales presentation for Zurich's 3-day workshop, and the workshop costs $1,997. I've actually been to some of these because I like to go and check them out and see what goes on because I have an interest in that, and that's exactly what they do. So the whole point of this is you'll see, and this is just this group here. I'm not going to call out other flipping people that are on TV. That's just part of the process. But really, these flipping TV or HGTV celebrities, they will probably license their content or their image or have a relationship with these companies, and a lot of them are based out of Utah, and there's a reason for that. Utah is a large call center place. A lot of these type of support and sales for these type of programs are run by Utah-based operations. I found that a couple of years ago. There's a reason why they pick Utah. I think it's, as a side note, apparently people in Utah don't have specific accents when they talk, and they are kind of like middle America, so people feel comfortable talking to employees who are based out there, and maybe they're just nicer people, who knows, right? But a lot of these operations tend to be based in the Utah, Salt Lake City area. So very interesting. The whole point, though, is that, and why this is kind of, it's funny, I'm being funny, sarcastic here, is I've attended these seminars, and the whole idea is you're going to see your typical stuff. Hey, I flipped this property, I made 50 grand. Oh, we fixed and flipped, we made 100 grand. Now, are these true deals? Yes, they are. Can people do them? Yes, you can. The likelihood of you actually doing the deals, you got to find a deal, you got to have the financing for it, you got to do the work, you got to flip it, you got to get it, the sales on the back end of someone actually buying it, you got to make that money. So, whether the 50 grand spread is the gross profit or whether the 50 grand spread is after acquisition, selling costs, closing costs, money like financing costs, because unless you have your own cash to put out to hold that property for the typical 6 months, 180 days it takes you to acquire, rehab, work, flip, and sell, someone's got to pay that nut for the money, whether it's hard money or you're using private funds, whatever that is. So this is where sometimes the $50,000 and $100,000 gets a bit muddied, because you really don't know, is that gross profit, and then in the end, what's the net? So if I'm doing a closing, and you can see this on TV too, and I watch these shows, I laugh because it might say acquired at 200, sold for 325, and then there's 125 gross profit. Well, on the 325, you've got 6% in real estate commissions. You've got a few points for closing costs, title company, document stamps, things like that. You're going to have a cost of money in there for the financing. You're going to have your material costs for your rehab. So the actual net is money you put back in your own pocket, and may be very different from this. But I can tell you that you go to these seminars, the game plan is to get you to a 3-day event. When you're at these events, the next gameplay is to sell you on a high-level coaching package, and that those are typically much, much higher, 10, 15, 20, 30, even $40,000 and $50,000. You have a dedicated mentor, and you're working specifically with somebody at their call center to help you grow in your real estate business and do these type of things. Is it worth that? Well, that all depends on your perception at the time and what you want to do, and whether you're paying for a friend or a mentor. You got to keep that in mind. But the point is, this is what goes on there. And I've been involved because I've worked with other online presence people who sell real estate, investment education courses, and they're not at the same. I don't mean the same level. They're not price pointed at the same level as the stuff on TV. That's the difference, all right? Typically, and a lot of the guys I've dealt with are good, and they're smart, and they have a system that works, and they have reasonable charges. But again, all this boils down to what you put into it. That's the whole point. But I do think it's kind of a bit interesting that now the FTC is going after these guys, and it's the claim. So now, as you know, I have my own products and services as well too. I've never said get rich quick, and I never will say that. I sort of focus on the market opportunity, and it's all based on what you do with it personally. I have people who bought the course and have done zero with it. I have people who are engaging in marketing as we speak right now. So the majority of people put the course on the shelf, and it's there. That's the way things typically work. But again, just keep that in mind when you're going to these seminars. By all means, attend the seminar and get your information, but realize what the next step is when you're there. All right, last here, I want to talk about California's heading to a majority renter state. How will this change the way Californians view housing? Well, this actually came out via CAR, California Association of Realtors, and they took the 2017 California renter rate by city, and it's too difficult to show you the cities here, but you've got essentially Santa Monica, East LA, all the way down to Sacramento, San Bernardino, and Escondido, and everything in between, and they're sort of extrapolating the numbers, and this is by 2025. You can see that this number, that's 76%, and this number is 50%, 50.7%. So they believe that of all these cities, they're going to be 50% renter population in these locations. And so what does that mean? That means housing is either unaffordable for most people, means they don't make enough money. I know there's been difference and discussions on rent control and stuff like that in the state of California, and that's a whole other can of worms that you can get into. We also know that with respect to prices have grown much faster than incomes. People now are talking about this. Before, it wasn't a spoken topic, reason being because jobs are great. So when jobs are great, people assume that income is great as well. Well, again, you could lose a job at $100 grand a year, and you've picked up another job for $40 grand, so you're an employed person, so you're a peg count on statistic, but from a income perspective, you're not making what you used to make, so it's more difficult for you. So this shows that clearly, and this is the average, income growth, at around 5%, across the board here, and you can see last housing crisis, and we're going back up with our bubble here. So again, prices have not grown prices have grown faster than the incomes. Wages have not kept up, and that's obviously affecting what's going on, especially in a market like California. Therefore, we see people leaving California to go to other locations for cheaper housing. We see companies going, we think we can do better if we move our operations to a completely different state, if we can do that. And that, what does that mean? It means everyone's saving money. It means their employees can work happily, not have the stress of what's going on with respect to housing costs and things like that. So there are a number of factors that work with this, but interesting to note that this is the projection from California Association of Realtors along with the U.S. Census Bureau. So very, very unique to see this. I look at this going, this means, more people will be buying investment properties here to satisfy that rental surge. More multifamily will be built, so it'll have its ebb and flow with respect to housing and what goes along with that. But again, when you have over 50% of people expected to rent, they have to live someplace. So you're going to see more probably corporate investment in housing and more multi being built as well too. So that's it for today. Basically, I want to thank you for the views. Thank you for the likes and comments. Please share the video. Still trying to work out some of the kinks on my new look here. We're trying to figure out the best location. Lighting's not that great. I've been messing around today for a half hour. Didn't like it, but whatever. We'll figure it out as time goes on. Yes, I have more than just black shirts, but if you're really concerned about how you look on camera, black is a slimming color. So I want you to remember that. That's why I typically like to wear darker colors. There you go. All right. So if you're not already a subscriber, please subscribe to my channel, help it grow. Why I'm doing this? Because I want the masses out there, people who are looking for homes and looking to keep their housing costs down, to succeed, buy a home, not pay a lot of money, enjoy your home, don't regret your house purchase. I mean, that's what we all should be doing, enjoying where we live, essentially. I do have programs, Never Pay Retail, which I'm still working on. Have my advanced short sale training. I can tell that the short sale market is picking up again. That's something you should be looking into if you'd like to purchase cheaper homes and discounted homes. So it's called the Short Sale Cash Connection. Drop me a line. You can email me at randy@luxuryshortsales.com. That's how to get a hold of me. It's the best way. If you do email, please put in your phone number, which allows me to text you and get back to you quicker as opposed to bumping back and forth with emails. Now, I talked about this the last time through, so if you're waiting to the end to watch the entire video, I do appreciate that. I need help with distressed properties. I need help, and I need distressed properties in the following cities. And the reason being because I have some significant buyers who are looking in these locations, and what they're not looking for is listed MLS that needs to be sold. They're looking for off-market or other deals that we could jump on. Again, they want to convert to rental homes, and clearly don't pay premium for rental properties. So keep that in mind. So the locations we're looking at right now are West Coast, Portland, Sacramento, Riverside, California, LA, Phoenix, and Tucson. Vegas and East Side, we're looking at Raleigh, Charlotte, Houston, Orlando, and Jacksonville right now. I have a few more locations we'll put on there as time goes on. So if you have connections, if you're a real estate agent in any of these locations and want to discuss short sales and working with me on that, please reach out to me. There's a lot of opportunity here. It's just going to get bigger and bigger. So anyway, everybody, thank you once again for watching, and hopefully we'll have another video out on the weekend or early next week. Thanks.